and just ask you this question about the dollar. Is it growth? Is it bond yields? Or is it the Fed that's really driving the dollar?
Oh, man, I think really it's people's faith in the Fed that's driving the dollar, at least lately. But you have to look at 10-year yields and what has happened. I mean, they've dropped 100 basis points between the beginning of last year and the low in August, and they've retraced almost that whole move. And so that in and of itself is going to help with rate differentials driving the dollar. Also looking at the German Bund and the U.S. 10-year differential, that has retraced about 50% of its move. So that's both has stabilized the dollar. But the big factor that people really aren't looking at and probably should is short-term rates. You look at a 2-year, still trading around 10 basis points, and that is people's faith, in the Fed keeping rates low until 2023. Therefore, we're going to see some dollar weakness or stumbling, as it were.
Does a combination of easy fiscal and monetary policy weaken the dollar as global competition for capital grows and financing the U.S. current account deficit requires a lower dollar?
That's right. And so that it's going to be interesting to see what happens, because there's two ways to look at that. When you have reflationary ambitions like the market's showing right now, you're going to have a global competition for capital. We have to finance a deficit that's probably not going to go away anytime soon. And so that's the case for the dollar stumbling. But on the other hand, if the Fed blinks and something changes with the market disbelieves and we see short-term rates rise, then the dollar will firm up. And I tend to be closer to the latter. And I think the dollar will continue to stabilize as opposed to drop off the cliff.
And Larry, yields up again. Well, up this morning after taking a breather for a couple days. We have the 10-year at 1.314. We currently have the 30-year at 2.099. So with yields on the rise, how much of this anticipated repricing over the course of 2021 has already really recurred? There's the argument that we should be worried about inflation. We shouldn't be worried about inflation. Let me get your take on it.
Yeah, so I think we're looking for inflation in the wrong places, and the market needs to see consumer-driven inflation, and that's what we're not seeing. I mean, we all know that inflation has gone into risk assets, et cetera, but we're not seeing it come through from the consumer, and I think a lot of that's due to structural demographic changes, et cetera, that just hard to explain. But all that to say, yields are creeping higher, and I think the mandate, the unwritten mandate, is let them rise until something breaks. And so far, the S&P 500, within 2% of its all-time high, maybe less, and rates are casually going up. But we have to keep in mind that the 10-year yield at 133 isn't exactly high; it's just relatively high from where we were. But you think about it, this time last year. At the start of last year, 10-year yields were 1.5. So it's all relative.
So investors shouldn't worry about that 1.4% import print we got yesterday, or the retail sales number at 5.3%. Explain a little bit to some of the new investors who here, focus on retail sales. Oh, it's increased 5.3%. Here comes inflation, or PPI came in a little bit hotter. Import prices came in a little bit hotter. You don't think these data points will really play into the inflation narrative?
Well, Stephanie, they definitely could, but as we all know, one data point or even two don't make a trend. And these numbers that are going up, especially like retail sales, that's a one-off, and that was a really important number, of course. But it's coming off like a very low level, as it were, and so we need to see more of that. And just like we saw overnight with all the PMIs that came out, the manufacturing PMIs all exceeded expectations around the globe, basically, but the services did not, and that's troubling. Because you need to have that. The services PMIs have to exceed, or should exceed, or continue to exceed, to drive that consumer inflation, and that's what seems to be muted at the moment.
And Larry, there were several headwinds yesterday that seemed to investor enthusiasm. Now, we are up today. For one, though, was Walmart's earnings and the outlook with the company seeing a relatively tepid earnings picture for 2022 fiscal year. Walmart is such a heavyweight in retailing, especially for lower income shoppers. That outlook may not bode too well for the trajectory of the economic recovery for those hit the hardest. What are your thoughts on earnings and if a single company report should really be that deeply looked into? I know you just said one report doesn't make a trend, but your thoughts on the weak report coming out of Walmart?
Yeah, and Walmart's was troubling, but from what I saw, the expectations were a lot higher than normal. Typically, it's the other way around, and companies beat expectations, and the bar is low. The bar was high in that case, but I just think that overall, earnings sometimes give a poor picture of what's going on in the market, and we have to realize that overall in the stock market, people think we have high valuations, but the fact is, like 90% of the S&P 500 market cap is based on intangible assets like R&D and software and intellectual property. And when I started in the business, it was probably 30% or less. So earnings beget valuations in stocks, and people get worried hearing all that. And the fact is, like, remaining diversified among industries has been proven to be the best bet. And I wouldn't suggest changing that now.
And Larry, another headwind yesterday was the rise in jobless claims. While the jobless news isn't good for the economy, it can also be interpreted as heightening the pressure on Washington to get a new stimulus package hammered out, which would likely be a bullish scenario for the economy and market. And adding to the nuanced picture, the housing data on Thursday were mixed. Housing starts coming in below expectations, but building permits exceeding forecasts. I know the housing market, the housing data has been exploding. We'll get another look into it today with existing home sales. But your thoughts yesterday on the increase in jobless claims?
Yeah, I mean, to me, it was a little troubling, but we're at the point where it seems like bad news is good. President Biden is trying to get a $1.9 trillion stimulus passed, and that would be theoretically good, or the market's interpreting that as good. And so, unfortunately, like, bad news tends to be good for the market because the market's expecting to see some stimulus. And has the market got ahead of itself? I think so, but the market always gets ahead of itself. It's kind of a bellwether that something will get passed. So for the time being, it seems like, moderately bad numbers will continue to support the market until something breaks. And I think that's where we are right now. And everybody's not overreacting, but over-focusing on one number, because we have yields at 133, we have the S&P near all-time highs, and just waiting for something to give. And so far, it's been pretty comforting to see the market act as it were, and really looking forward to seeing today's close, how everything plays out.